The world of banking can be complex, ambiguous, and volatile. We, as depositors, place a lot of faith in a system that, frankly, most of us don't understand. Yet, banks are at the center of our financial lives. Paychecks, transactions, mortgages, savings, credit cards, the list goes on. The recent collapse of Silicon Valley Bank in the US has served as a reminder that banks can and do fail. Whenever it happens, there's always a chance that depositors could lose money. As onlookers in Ireland, it can be challenging to know whether bank failures abroad are cause for concern. If it can happen to SVB or Credit Suisse, what's stopping it from happening to AIB, Bank of Ireland, or PTSB? So in this video, we're answering the question, are Irish banks safe? In the first section, we'll talk about how your bank deposits are protected in the event of an Irish bank's collapse. Next, we'll talk about how Irish banks are holding up in this high and rising interest rate environment. We'll then take a look at how Irish banks stack up against Silicon Valley Bank and whether any parallels can be drawn. Finally, we'll take a look at the key safety metrics for Irish banks in order to assess whether or not there's any cause for concern. All sections of this video will be timestamped for your convenience. Let's kick things off by talking about your deposits. How safe is your money in the hands of Irish banks? In order to answer that question, a distinction needs to be made between covered and uncovered deposits. Under EU legislation, member states, including Ireland, are required to provide a guarantee to depositors. This is known as the Deposit Guarantee Scheme, and it's administered by the Central Bank of Ireland. Under the Deposit Guarantee Scheme, your deposits are protected up to the value of €100,000 per bank. So if you had 200 grand on deposit with AIB and AIB went under, you'd get 100 grand back and you lose the remainder, provided there was no government intervention. However, if you split your 200 grand 50-50 between AIB and Bank of Ireland and both go under, you'd get the full 200 grand back. Not all deposits are eligible for the Deposit Guarantee Scheme. Aside from the €100,000 limit, the guarantee only applies to deposits held by individuals, sole traders, partnerships, clubs, companies, certain trusts, and small self-administered pensions. Deposits made by the likes of banks, investment funds, and pension schemes aren't eligible. Deposits that are eligible for the guarantee are referred to as covered deposits, while those that aren't are referred to as uncovered deposits. According to the European Banking Authority, in 2021, covered deposits in Ireland equated to €129.2 billion, meaning in a doomsday scenario, that's the amount that Irish depositors would be owed. But where would that money come from? Part of it would come from the Deposit Guarantee Fund. The idea behind the Deposit Guarantee Fund is that it's funded by the banks and not the taxpayer. In other words, banks are funding the cost of a potential bank failure in the future today. This is done by way of an annual contribution by the banks. For example, in 2022, AIB contributed €55 million to the Irish Deposit Guarantee Scheme. However, in reality, the Irish Deposit Guarantee Fund would be totally incapable of funding the cost of a doomsday scenario. EU legislation requires member states to have a deposit guarantee fund equal to just 0.8% of covered deposits by July 2024. Assuming that covered deposits will equal €150 billion by July 2024, the value of the Irish Deposit Guarantee Fund will be just €1.2 billion. The vast majority of the cash required to cover deposits would have to come from what the European Banking Authority calls alternative means of financing. However, no guidance has been provided as to what that financing would look like and who would provide it. Regardless, that would be the state's problem and not yours, unless of course depositors were bailed out using a combination of both taxpayer money and public debt, in which case it will become both your problem and the problem of future generations. Doomsday scenarios aside, if your deposits are covered by the Deposit Guarantee Scheme, then the safety of Irish banks should be of no concern to you, because your money is guaranteed irrespective as to whether or not they are in fact safe. This is why deposit guarantees are instrumental in preventing bank runs where large numbers of depositors attempt to withdraw their money from the bank at the same time. A bank run is ultimately what led to the downfall of Silicon Valley Bank. If depositors know that their deposits are guaranteed, then they have no incentive to run. Therefore, the question of whether or not Irish banks are safe is more relevant to those with uncovered deposits, i.e. high net worth individuals, businesses, and financial institutions. However, it goes without saying that the health of the Irish banking sector is a key determinant of the health of the Irish economy as a whole. So irrespective of deposit protection, it's in everyone's best interest that Irish banks are and continue to be in good standing. That begs the question, how are Irish banks doing? Evidently, pretty well. In November 2022, the Central Bank of Ireland released a report entitled Rising Interest Rates and Higher Inflation: Implications for the Banking Sector. The report notes that Irish bank stocks have outperformed other international banking sectors since 2020. While not the only reason for stock price appreciation, it's likely that the market is anticipating Irish banks to fare better in a high interest rate environment than banks in other jurisdictions. As the report notes, Irish banks rank among the highest in Europe in terms of the share of net interest income relative to total operating income. Indeed, when we look at the financial statements for AIB, Bank of Ireland and PTSB, we can see that net interest income comprises 74.58, 76.75 and 88.51% of total operating income respectively. Therefore, the profitability of Irish banks is heavily predicated on the net interest margin. A bank's net interest margin is the difference between the interest rate that the bank earns on its loans and other assets and the interest rate that the bank pays to its depositors and other institutions. The higher the net interest margin, the more profitable the bank, especially when net interest income represents a large share of total operating income, as is the case with Irish banks. AIB, Bank of Ireland and PTSB all saw net interest margins increase between year-end 2021 and year-end 2022. Bank of Ireland had the highest net interest margin, standing at 1.96%, followed by AIB at 1.74% and PTSB at 1.54%. By definition, this means that Irish banks are benefiting from the higher interest rate environment, and it's not hard to see why. During the pandemic, household deposits increased significantly. On a proportional basis, this increase was among the largest in Europe. PTSB saw total deposits grow by 13.84% in 2022, AIB by 10.22% and Bank of Ireland by 6.93%. Irish banks are predominantly funded by customer deposits, as is illustrated by bank total deposits relative to total liabilities. Compared to European banks, Irish banks have lower loan to deposit ratios, meaning they are less reliant on expensive wholesale funding to fund their lending operations. This funding structure generally results in an improvement in net interest margin when interest rates are rising. As was noted in the European Central Bank's 2018 paper, Who Bears Interest Rate Risk, it's well known that banks exert market power in retail deposit markets, giving rise to limited pass-through of market rates to deposit rates. In other words, banks are slow to pass on the benefits of higher rates to depositors because they don't have to. The paper Why Do Banks Invest in MBS attributes this market power to the fact that depositors are hesitant to leave their bank even when they can get a better rate elsewhere. This allows banks to keep their funding costs low and to increase their net interest margin. This market power is especially prevalent among Irish banks. Not only are the banks flush with customer deposits, thereby limiting the need to incentivize depositors with higher rates, but there's also only 3 retail banks in operation in the country. As was noted by the central bank, this reduction in competition might mean that banks have greater capacity to boost profit margins relative to banks and economies with a more competitive banking sector. The other side of net interest margin is the lending. The majority of Irish mortgages are made up of variable, tracker and 1 to 2 year fixed rate mortgages. As was noted by the ECB, banks granting mortgages in countries with predominantly variable rate contracts tend to benefit from higher interest rates, as the income on these assets reprices quickly and the present value loss from higher interest rates is less severe than for fixed rate assets. Indeed, in 2018, Ireland's share of variable rate mortgages was much higher than some of our European counterparts in the likes of France, Belgium and Germany. Even though there has been a large shift away from variable rates in Ireland since 2016, existing fixed rate terms are relatively short, meaning that the banks would benefit from customer refinancing at higher rates at the end of the fixed rate period. In essence, this means that the bank's interest income is quickly adjusting upwards in response to higher rates, while interest expense on deposits is nowhere near as responsive, thus leading to an improvement in net interest margin. So we know that Irish banks are benefiting from rising interest rates, but how do Irish banks stack up against Silicon Valley Bank? Size-wise, SVB was bigger than AIB, Bank of Ireland and PTSB. SVB's total assets at the end of Q4 2022 stood at $212 billion. AIB, Bank of Ireland and PTSB have total assets equal to 129.7, 151.3 and 25.9 billion euro respectively. However, the facts and circumstances which led to SVB's failure are entirely different to the facts and circumstances which apply to Ireland's three largest retail banks. SVB's depositor base was highly concentrated in startup companies. In addition, nearly 94% of SVB's deposits were uninsured, which is the equivalent of uncovered deposits in Europe as they relate to the European Deposit Guarantee Scheme. So what you had was a group of depositors largely confined within the same startup community who would lose the vast majority of their money if SVB was to go bankrupt. This heightened level of depositor risk, coupled with bad investment decisions made by SVB's management, ultimately led to a run on SVB and the collapse of the bank itself. Irish banks don't disclose the value of customer deposits which are covered and uncovered. However, according to the Central Bank of Ireland, total deposits in Ireland amounted to 310.5 billion euro at the end of February 2023. If in 2021 covered deposits in Ireland equated to 129.2 billion euro, we can make a pessimistic estimate that 58.39% of Irish bank deposits are uncovered deposits. In other words, in the worst case scenario, 58.39% of total deposits would have an incentive to run on Irish banks if fears of loss started to mount. Clearly, this is much lower than SVB's percentage of 94%. What's more, Irish deposits are well diversified between households, businesses and financial institutions, unlike SVB, which had the majority of its eggs in one basket. SVB also did very little to hedge its risk against rising interest rates. As banks primarily invest in fixed income securities like mortgages and government debt, they are susceptible to interest rate risk, both in terms of the cash flows received from investments and the fair value of the investments themselves. At the end of 2022, the notional value of derivatives held for hedging purposes by SVB was $1.9 billion, which equated to around 0.92% of total assets. Comparatively, the notional value of derivatives held for hedging purposes by AIB and Bank of Ireland was 54.3 and 83.2 billion euro respectively, with a large uptick in hedging activity recorded between year-end 2021 and year-end 2022. These derivatives equate to 41.91 and 55% of AIB's and Bank of Ireland's total assets respectively. In other words, both of these banks are well hedged against interest rate risk. PTSB, on the other hand, held no derivatives for hedging purposes at the end of 2022. Irish banks are also well positioned in terms of their requirements under Basel III. The Basel Accords, specifically Basel III, refer to the minimum requirements and safeguards that were imposed on banks internationally in the wake of the Lehman Brothers collapse in 2008. Two key ratios were introduced: the liquidity coverage ratio, or LCR, and the net stable funding ratio, or NSFR. These ratios are designed to protect depositors, banks, and the stability of the financial system as a whole. The LCR measures a bank's stock of high-quality liquid assets relative to the net cash outflows, i.e. deposit withdrawals, that the bank might experience over a 30-day stress period. In other words, does the bank have enough cash and liquid assets to meet a high level of withdrawals? Liquid assets refer to cash and investments that can easily be converted back into cash without having to sacrifice on price, i.e. short-term government bonds. A healthy bank will have an LCR well above 100%. The higher the LCR, the more likely it is that a bank will be able to deal with a reasonably sized bank run. At the end of 2022, AIB, Bank of Ireland and PTSB had LCRs equal to 192, 221 and 178% respectively, well above the minimum requirement of 100%. The NSFR, on the other hand, is designed to limit mismatches between a bank's long-dated illiquid assets and their readily available funding from deposits and other sources. Again, banks with NSFRs in excess of 100% are considered to be in good standing. At the end of 2022, AIB, Bank of Ireland and PTSB had NSFRs equal to 164, 163 and 154% respectively. It's worthwhile mentioning that that, unlike Irish banks, SVB wasn't subjected to the LCR or NSFR requirements under Basel III. Another key line of defense in banking is Common Equity Tier 1 or CET1 capital. Put simply, the equity value of a bank, i.e. the value of bank assets minus bank liabilities, must be kept at certain minimum levels relative to the bank's risk-weighted assets or RWAs. Not all bank assets are equal in terms of risk. Therefore, the logic of using RWAs is to match a bank's capital requirement with the risk profile of its assets. The riskier the asset, the higher the capital requirement. The purpose of CET1 capital is to mitigate the risk of bank insolvency by ensuring that banks have the capacity to absorb a certain degree of loss on their assets before becoming insolvent. The higher a bank's CET1 ratio, which is calculated as CET1 capital divided by total risk-weighted assets, the greater its solvency. At the end of 2022, AIB, Bank of Ireland and PTSB had CET1 requirements of 10.23, 10.04 and 8.94% respectively. Each bank surpassed their CET1 requirements by a significant margin, coming in at 16.3, 15.4 and 15.2% respectively. In other words, 16.3% of AIB's risk-weighted assets would need to be wiped out in order for AIB's CET1 capital to be fully absorbed. In addition to CET1 capital, you also have additional Tier 1 capital or AT1s, which was at the forefront of the Credit Suisse takeover, as well as Tier 2 capital. Considered in totality, AIB, Bank of Ireland and PTSB have total capital ratios of 21.3, 20.5 and 21.3% respectively. These are strong capitalization ratios. For context, the paper Benefits and Costs of Bank Capital notes that capital in the range of 15 to 23% of risk-weighted assets would have been sufficient to absorb losses in the majority of past banking crises in advanced economies. In conclusion, Irish banks are indeed safe. At the depositor level, the Deposit Guarantee Scheme ensures that deposits are protected up to the value of 100 grand per bank. Unlike SVB, Irish banks are funded by a healthy percentage of covered deposits, thus mitigating the risk of a bank run. Irish banks themselves are performing well under the high interest rate environment. This is largely thanks to ample retail deposits and increased cash flows from variable and tracker mortgages, as well as fixed rate mortgages which have been newly issued or refinanced at higher rates. The quality of these mortgages is much higher now than in 2008. That's largely thanks to the conservative lending regulations imposed by the Central Bank of Ireland. As a result, it's less likely that the banks will experience large losses to their loan book, which would eat into bank equity and threaten bank solvency. Even still, Irish banks are exceeding their minimum liquidity and capital requirements under Basel III, thus providing ample protection in the event of losses. If you enjoyed this video, can I ask that you take just 2 seconds out of your day to show your support by leaving a like on the video, subscribing to the channel and sharing the video with family and friends. What are your thoughts on Irish banks? If you have any questions about anything that was covered in this video, please don't hesitate to leave a comment down below. Before you go, make sure you check out this next video, which talks about the collapse of Silicon Valley Bank and its implications for Europe in more detail. Thanks very much for watching, and I'll see you soon.